Governor El-Rufai, the next question is to you. We've seen that Nigeria's public finances are under acute stress as it is right now, which has also increased debt and deficit. What effects is this really having state-level fiscal sustainability and public financial management? You can answer that. I'll come back to the second question to you later.
Thank you, Nancy. First, let me thank the World Bank for this presentation and for bringing forth another country economic memorandum. I think is extremely helpful, brings out the problems and shows the trends and trajectory. As a state government, we are at the receiving end more than the federal government in terms of these fiscal pressures. Since 2021, the NNPC had stopped contributing a cent to the Federation account from proceeds of oil revenues. They claim that the entire domestic oil revenue, our share of joint ventures and production sharing contracts, when they sell, is not even enough to cover this PMS subsidy. In the National Economic Council, where the Vice President chairs with all the state governors and the central bank governor as members, we saw this problem building from around March in 2021, and we raised the red flag, and a NEC committee was formed to study the problem and come up with solutions before it gets out of whack. At that time, we did not even anticipate some of the things happening now, like the Russia-Ukraine war having all this global impact. We agreed, and we worked with the bank at the time, we agreed by November 2021 that this subsidy should go, because we could see that at best it will reduce state revenues by about 20 to 30% in 2022, unless it is ended. And that would have significant impact on the solvency of many states. And we all agreed on that, and the federal government seemed to agree, but somehow the consensus was not implemented. Now, most state governments, other than the oil-producing states that still get their 13% derivation, whether something comes to federation account or not, most of the states that are not oil-producing, Lagos accepted because of their large tax base, are under pressure. We all know, and we can see very clearly, the impact of the fiscal trends in the last 12 months on the minimum wage and the earnings of Nigerians. But what can we do about it? Ideally, we should quadruple or multiply 5 times the current levels of wages and salaries, but we simply can't afford it. Many states are struggling, and we are back to 2014, 2015, when the Buhari administration inherited about 27 subnationals with salary arrears. We are getting back there. So this has a major impact on us, and unlike the federal government, we do not have recourse to central bank financing. And frankly, the states are the multiple losers of some of these policy misalignments. Last night, we were at the Nigerian Governors Forum meeting discussing SIFTAs. The World Bank came and briefed us. All the states have done very well. We surprised the World Bank by outperforming what was predicted. So the World Bank needed $375 million to settle all of us, but they had only $200 million because they didn't think that Nigerian states will implement the far-reaching reforms that they recommended, but we did. Almost all the states, met all the targets, so the World Bank can only give us a fraction of what we're entitled to. But after the World Bank left, the issue being discussed was at what exchange rate are we going to get what we are due? Because the central bank will take the dollars from the World Bank, sell it at whatever price, we don't know, but they give us the Naira equivalent at the so-called official rate that only the governor of the central bank probably believes is the rate. So we had that discussion. And this, as I said, is really, really affecting states. And it is the state governments that have primary responsibility for core social services like primary education, primary health care, and so on. How can we deliver that when we are struggling to just pay the salaries of our public servants?